Welcome to the Merryn Talks Money Market Wrap, where we talk about the biggest moves in markets this week and what's been driving them. I'm John Stepek, senior reporter and author of the Money Distilled newsletter, and then joining me in the studio today is Bloomberg's private company's managing editor, Neil Callanan. Neil covers hedge funds, asset management and real estate in EMEA. So in today's show, I basically wanted to talk about the AI industry. I wanted to give a structure out of what it's actually about, lay it out so that you can understand it better. The kind of who's producing the chips and who's producing the models, and then wanted to look at how that's funded and why there are some concerns about perhaps the circularity of some of the deals in the industry. And Neil has written a lot about that. Thanks very much for being with us today, Neil. It's great to have you on the show.
Thanks for having me, John.
Not at all. So we're recording this on Wednesday, and probably the biggest story so far this week has been the rout in the South Korean Kospi index. And basically this is driven by the fact that the Kospi is, half of it is comprised of two stocks that are related to the AI boom, and that's SK Hynix and Samsung. And also there is an element of retail investors getting in over their heads because they've been able to buy all these leveraged ETFs. And so the Kospi went up a lot and then down a lot. I mean, one of the stats that really jumped out at me is that it's actually still up 35% on the year, but in the last month it's fallen 34%. And so okay, that's a proper roller coaster moment. But does this tell us, or what does this suggest is about the overarching AI story? Because it's not just about Korean leverage, there's other stuff going on too, isn't there?
Absolutely. And Korea in a way is a special case because Korea has almost gamified the finance industry and the stock market. And you mentioned the leverage ETFs, but they've been big on crypto and Tether and things like that, stable coins, for a long time. And you know, a lot of those investors in retail have grown up very accepting of those levels of risk. And in many cases, it has paid off. So as you said, the Kospi is still up this year, despite the rout in recent weeks. But what is driving a lot of the change at the moment is the fear that China is catching up. And China's emergence in AI, which was always going to happen, but perhaps faster than people thought, is really concentrating minds at the moment. And we have seen in the past when DeepSeek came out of nowhere and released its models, the market disruption that caused. And now we're going through a kind of second bout of that, where in the space of just over a week, you've seen massive progress in terms of memory chips, in terms of language models. And so China is definitely emerging. And one of the things around all this spending that we're seeing in AI is the assumption is that people are willing to pay for it. And will pay a lot for it going forward. And then suddenly if you have these cheaper models coming out of China and people start switching to that, then what happens with the names we're all familiar like OpenAI and Anthropic. And so, you know, there's definitely fears in the market about that at the moment. And I think people are definitely taking pause globally as a result of that. At the same time, a lot of this money is going to be spent. There is an investment case for it. It's whether it's getting ahead of itself at the moment. And certainly in terms of valuations, it did seem to be getting steamy at one point this year.
Yeah. I mean, I thought we'd just kind of lay out roughly the AI industry and the business model, because I think a lot of the time, you know, we sort of talk about AI and it's quite an amorphous kind of blob, and a lot of the time we're thinking about ChatGPT. I mean, no, NVIDIA is in there somewhere and all the rest of these things. But so I was kind of looking at it, and actually I was talking to AI about it, and getting a sense of what the kind of value chain is. So you've got the machines that make you've got the companies that make the machines that make the chips, and that's like your ASML that makes the kind of lithography machines. And then you get the chip foundries themselves, and that's like the Taiwanese company TSMC. You've got chip designers, and that's NVIDIA. So they're the ones that basically do the kind of value add element, isn't it? It's like they're making the brains for these things. And then all of these chips go into big AI hotels, the kind of data centers, and they're run by the same people that run what we used to call internet hotels, the kind of data servers like the Amazons and all the rest of this world. And then you've got the people who actually make the AI models, and the AI models, the brains of the AI live on the data centers. And that's like your OpenAI. And then they're selling them to companies, either big enterprise providers who kind of like garnish their existing offerings with AI, or end users like me and you, or smaller companies. Is that about the size of it? Does that kind of sound about right in terms of what the AI value chain is and who all the companies are involved in this?
100%, but like this is so massive now that it encompasses everything else as well. So like they need energy. And so we're seeing a massive boom in energy, and people are talking about needing up to 300 gigawatts of additional energy power by 2030. That's enough to power 225 million homes for a year. That's just for data centers. Now, those things have to be built as well. You have to get people to build the data centers and build the energy infrastructure, etc. So construction firms are taking off as well. And so, you know, in the US in particular, it's driving a lot of the economic growth, and any slowdown in this kind of spending will be negative for growth, not necessarily turn recessionary or anything, but it would be negative for growth in the US. But this goes back, your point about in the end, it comes back to the end users, goes back to my point about China in a way, which is that, you know, we need people at the end to be paying for these services in order to justify these investments. And when you look at the amount of money that are being spent by some of the hyperscalers in particular, which are these internet hotels originally, as you described them, you know, if you look at Alphabet's recent filing, its forward spending commitments rose $500 billion, essentially, in 3 months. Now, future revenue growth grew, but not by anything close to that. And that goes back to the fears people have about this entire ecosystem that is sucking up so much money and so much capital at the moment, that people are kind of going, well, I don't know whether I want to have as much exposure as I could have to this. And you're starting to see that in the credit markets as well, where people are becoming much more discriminating about the deals they invest in and the price they're willing to pay, and they're also hedging a bit more. So this week, CoreWeave's CDS, which is a form of hedging against default risk, that's risen to almost a record. CoreWeave is one of these companies that is like a WeWork of the GPU world, which is the chips, and they basically rent out to other people what they're doing. And, you know, people have become much more cynical in the last few weeks about deals, partly because they know so much of this stuff is coming to the credit markets that they don't have to buy everything. And the question is whether people in the AI industry as a wider thing have become too complacent about the idea that the credit markets will be there and be supportive of them. And that's not necessarily always going to be the case.
Well, I mean, I think that it's fascinating from that point of view, in that there really has been a deluge of bond issuance, hasn't it? I mean, we're talking about what was, by some measures now, the hyperscalers are the biggest issuers of corporate investment grade debt, and you're used to it being the banks. And the other point about hyperscalers is that before all this, they were basically running on their own cash generation. They were deemed as being essentially impregnable balance sheets. And while it's not negative that they've started, you know, raising, or not started, they've now got a lot of debt. And for example, like Alphabet, its latest quarter was its first negative free cash flow quarter ever since it listed. It's just a sort of sign of how much is out there, and how these businesses are kind of fundamentally being changed by this. And then you throw in China maybe turning around and doing it all much, much cheaper, and suddenly you're kind of like, oh, wait a minute, your earnings are going to be crushed, or sorry, the earnings that we're hoping that you get might get crushed by this. And one thing I thought was really interesting, going back to the debt point, is you were involved in putting together this very complicated and now famous in a sort of local way chart about how this is all being financed. And one of the big things that's, I think, slightly worrying people as well is that a lot of the money seems to be coming from the people who, you know, raise the money in the first place. So like almost like a form of vendor financing, where you've got companies that kind of make the chips paying the people who buy the chips, or who are going to rent the data centers that use the chips. Can you talk to us a bit more about that and how that's kind of panning out?
Yeah, what happened late last year was I was sitting there reading story after story about these deals where companies were doing deals with other companies in the AI universe. NVIDIA has always been at the center of this, but the likes of Google and Anthropic and OpenAI were doing all these as well. And I literally couldn't keep up. And so we just had the idea that maybe we need to do a visual here and kind of show the levels of circular deals that are happening. And, this became something of a bad word in the 1990s with fiber optic, and when there was a big rollout of that and lots of spending, and there was vendor financing and there was capacity sharing and various other things. And then a lot of those companies went bust when the demand wasn't there at the end, having invested in all that money. Now, of course, the irony, of course, is that long term the economy benefited massively from that level of spending. It's just the companies involved didn't always, and many of them ended up going bankrupt.
Well, that's the infrastructure story, isn't it? Because, the railways are still here and we still have trains, but a lot of the companies about them went bust, and same with .com.
And that happens with most new technologies. And again, that goes back to why investors are being somewhat skeptical at the moment about that. But these circular deals, they can create misaligned incentives around things like, are you making the decision in the best interest of the company? Are you making it in the best interest of the company that invested in you and is one of your biggest customers, etc.? And does that mean you're not devoting resources to something else when perhaps you should be? It also raises the question of whether there might be misaligned values. So yeah, the deal is being done at, let's just say, 7 billion valuation. But if that was with somebody else, might have been a 4 billion deal. You're also creating customers for you who are beholden by those contracts, and then that like essentially creates regulatory risk as well, where regulators may come along and go, actually, we don't like that, we're not sure whether that's the best deal for the consumer, and so all these risks are emerging that perhaps we didn't have before. But the biggest one probably of all is that these circular deals can create a false impression of demand, and you may think that all these companies are generating massive revenues, but if it's all just moving around and sloshing around, then if something falls out of bed, then there could be wider implications, and that could become systemic.
Yeah, well, that is what I was going to ask, because obviously that's kind of what we worry about. Because the other thing I thought was interesting this week is that although Kospi's fallen out of bed, the Nasdaq took a bit of a bump, but not a big one. It so far seems to be restricted largely to the AI and the tech sector, and actually plenty of other stocks are doing fine. The equal weighted S&P is doing fine, as in that's the S&P that's not wholly invested in the tech sector. And also the FTSE 100 is almost back at a record high, the kind of laggard of the global stock markets. But is this issue of how much does this spread, or could it spread beyond the tech sector? So who else is involved in lending to these companies? And if something did break down there, sort of where are the contagion sort of vectors?
The demand means that the AI industry has had to go to pretty much every corner of the credit market and hand out the bowl and kind of say, give us a few quid to fund what we need going forward. And so you're seeing everything from direct lending, which is private credit usually for infrastructure, so like just to build a data center. You're seeing investment grade. You're also seeing these neo clouds like CoreWeave, who I mentioned, who are sub-investment grade. Sometimes, not all of them, but some of them are sub-investment grade. So that's the high yield market, the junk bonds that people might know. They're in the structured credit markets. So they're, these are basically taking bond payments that are due and slicing them up by risk and selling them off to people.
Yeah, man, that reminds me. Didn't something like that happen in the mortgage market? What was it, 20 years ago?
It did. We haven't got to kind of the CDO level or CDO squared level yet.
Well, that's good. That's reassuring.
But like, where I would be concerned around that lending in particular is around what in real estate is called speculative lending, which means something else to many people, but in real estate, it's basically building the stuff before you have a tenant.
Yes.
And if you can get finance from that from a bank or from a private credit lender, that says something about bubble territory, because they are taking a complete risk that you are building this thing over the course of 5 years and you will find somebody to occupy. And if not, or if the industry moves on and technology moves on, you can end up with a very expensive elephant at the end, which may not have much residual value for people.
Yeah, if you build it, they will come. It only works in Field of Dreams, doesn't it?
Yeah. I mean, there can be a first mover thing where you can get away with it, but if you're spending 5 billion quid, it's building a data center. I certainly would want to be more certain of that. But we are beginning to see elements of that, and we're also beginning to see terms being pushed within those deals for lending that maybe are too generous to the hyperscalers. That is the point of view of the credit markets. So you're starting to hear things like, after a certain amount of time, if the project is delayed, then the hyperscaler can back out. Now, if you've invested 5 years and spent, as I say, $5 billion in building a data center, and it gets a bit delayed because, let's just say, something got stuck in the Straits of Hormuz at the moment, that's a very big risk. And so, again, that's part of what's happening with the credit markets and the pullback. They're kind of reconsidering some of the levels of risk that they're accepting at the moment.
I mean, from that point of view, this arguably, as long as it's not already going too far, might be a good thing. As in, maybe it gets everyone to rein in their horns a bit before it does go properly pear-shaped.
Yeah, and I think it was always going to happen. And to be fair, like, you look at something like the Kospi and it's still up, you know, many of the companies in it are still up over 100% year to date. In some cases, with AI adjacent companies are up 300% for the year. So that, you know, and there was a natural moment for a pause anyway. And what we are seeing in terms of the Chinese evolution is that was always going to happen as well. And China's big advantage is it has cheap electricity, so the tokenization is cheaper. So if you're a company that's also been spending loads of money on AI and your staff, it turns out, are using it to convert Excel files into PDFs rather than actually, you know, using a much cheaper technology for that, you're going to be scattering around for cheaper prices. And so, you know, China and the Chinese LLMs become a natural kind of success story from that. And you know, that was all to be expected, I think, within a certain reason. And it's just all happened very quickly and all at once, as it does these days in markets. And there's a bit of panic in certain areas, particularly when it comes to retail money. You and I have spent years writing about retail money being hot money and how people can panic. And to be fair, if I had leveraged several times, I would be looking at that and kind of going, oh my God. So it's understandable in a way. But, you know, if people are sensible about how they invest, there's still major opportunities there.
Yeah, I mean, my heart goes out to the various kind of rookie retail investors in South Korea who are now looking at, you know, some really nasty losses. I'm hoping that they were all young enough to bounce back from it. Thanks very much for this, Neil. That's really helpful. The one other thing I would ask you about is on the debt side. So we've flooded the kind of the debt market, if you like, and we have also seen a bit of equity issuance. And I suppose the other thing I'm wondering about is how much can the market take whenever we've had decades of de-equitization, so companies buying back all their shares or you know, getting bought off the market, and now we're going to get quite unusually kind of net equity issuance quite possibly this year. I mean, what does that say to you about what might happen regarding the tightness of money overall? As in, it's just not going to be enough to go around for all the hungry mouths? Or
I think investors will be discerning. I mean, you can tell an equity story that people will follow. I mean, just think within AI, how many of these companies we had heard of 3 years ago? Very few, if any. And yeah, you know, and they may not have very much revenue, but people are willing to bet on a deal. But there's also a thing of like, it can go wrong quite quickly. And SpaceX is probably a good example of that. Not necessarily went wrong, but there was so much hype, and now it's obviously down since its IPO price, which was ambitious in the first place. I looked recently and the short interest on the stock was at near 40%. So people are being very bearish on the future for it. And that's probably the big question for investors at the moment. SpaceX being partially an AI story with data centers in space, etc. Has that and what happened to that stock closed the IPO window for a while? And in that sense, then the focus would shift back to the equity markets, to the credit markets. And the credit markets, Sculptor, I think it was, put an investor letter out recently, and they talked about how credit capacity is needed at its greatest extent, just as people are pulling back. And that's something you have to be a bit fearful of, I think. Now, often we have thought these things, and 2 weeks later, the market has said, oversold, and it's all popped right back up. And often exceeding the previous highs, obviously. But at the moment, it's definitely a moment. It's just the length that moment takes.
Great. Well, look, thanks a lot, Neil. I think that was really helpful. I hope, like I said, the main point here was to try and explain to people what's going on, and I think you've done that excellently. And obviously, the market can remain excitable for longer than anyone can remain solvent, especially if you're invested in a leveraged ETF. So just be careful out there. Thanks again, Neil.
Thank you.